If you manage your own investments but struggle with a trade-off between performance and principal, this is for you. The Rocklinc Principled Equity ETF, ticker RKLC, was built for investors who want strong equity exposure without compromising their convictions. RKLC applies Rocklinc's time-tested approach with disciplined screening, long-term thinking, and a principled investment framework, so you can feel confident in the investments you hold. If you're a self-directed investor looking for a more intentional ETF, learn more at rocklinc.com/ETF or contact the Rocklinc team at info@rocklinc.com. Back with more, our final segment of the Monday, March the 16th. Thank you so much for tuning in. Our good friend Jonathan Wellum joining us, CEO of Rocklinc Investment Partners company. We very much appreciate their sponsorship of this program. Now we've got Jonathan, oil down by, I want to say 4.5% and down to $94.23. So that's a good move. And as you would expect, as a result of that, markets are up about 0.8% on the Dow. So it's up about 376 points. And then NASDAQ is also up about 1.2%. These are positive signs. Is this something that we should take, that the market thinks that the war in Iran is not going to have as big an impact on energy as maybe first feared?
Yes, that's what the market's pricing in. In fact, if you look out on the futures of the oil market and you go out about 3, 4, 5 months, you see the prices are down to about $60. So in fact, the market is anticipating that the end of hostilities will take place probably in the next few weeks anyway. And in the very least, the Strait of Hormuz will not be interfered with to the extent that it could be. As 20% of the oil goes through that strait, if that was actually hindered completely, 20%, we would see $150, $200 barrel oil very quickly. But it is sneaking through. The Indians are getting some of the oil through. The Chinese are getting some of the oil through. So there is some movement. And clearly the United States and the Israelis have done serious damage to Iran. And so I think the market's anticipating that a lot of that will be freed up in the next month or so.
Let's talk about private real estate funds. Okay. People think of REITs, these are real estate investment vehicles,
right,
as the way to invest in the public real estate industry. And it's a way to say, for instance, if you don't own your own property, you could still invest through the stock market on these investments that are based on land and homes,
right?
Office buildings or real estate. But there are also private real estate funds that you want to talk about today. And exactly how do they work?
Yeah, so the REITs, as you pointed out, those are publicly traded. And a lot of times people like to buy them because you're saying, okay, this is a hard asset. I'm buying a certain type of real estate. Maybe it's long-term care facilities. Maybe it's retail real estate that's supporting commercial properties, et cetera. And then you get a nice income stream. And so it's really the income stream that people are very hungry for, along with a steady capital growth. And so over the years, the REITs have been pretty volatile, and the institutional market, and so pension funds and people that have larger sums of money, they often have put money into private investment vehicles so that these are non-public. What's happened the last 5, 10 years is these private real estate funds have expanded to the retail market. So you and I and everyone else on the street can now buy these. The problem is that they are not public. And so you don't have the same level of liquidity. And be that as it may, about $80 billion has gone into these private real estate vehicles. Currently, there's a little bit of pressure in the marketplace. So we've had them not performing as well as investors thought. We've had pressure because the economy is not growing very quickly. And what's happened is about 40% of that $80 billion are now in funds that are gated. They're actually not letting investors take the money out at the pace at which they anticipated. And so this is a big concern, because a lot of times with the real estate market, people got concerned. They say, listen, I want to take some of my money out. And all of a sudden they go, oh, there's too many people wanting their money out at one time. And since these are not publicly traded, we can't sell the real estate, the underlying asset, as fast as possible in order to meet the redemptions. And so a lot of retail investors that are not that sophisticated were sold these products. And sometimes we've seen clients come into our business with 50 to 80% of their assets invested in one of these funds. They were expecting a nice income stream, 6, 7, 8%. And all of a sudden they find out they can't get their money out. The income stream is now being chopped down to 2 or 3%. And they're really feeling the pressure. And so I think, again, this is a warning to retail investors. If you're going to go into a private investment, you have to have a longer time horizon. You must diversify. You don't concentrate yourself into just a couple of vehicles. This could become a real nightmare because we haven't seen big write-downs yet. That is the writing down of the values. But that could come, again, given the Canadian economy is very soft and we've got all the problems that we've got going on here in Canada with very little economic growth. So you've got a lot of investors who wanted the income's got chopped down, they want to pull a little bit of money out, they can't get the money out, and worse, in the next little while, I'd suspect that some of these might have to take write-downs on the value of their investments. Again, this is an area you've got to be very careful as investors. We get very concerned when we see investors come in with high concentrations. Again, the idea, Mark, is that real estate never goes down. And yes, real estate does go down. It might go up for a long period of time, but the longer period of time that it's gone up, the more probability it's going to be that it's going to come off. And that's what we're seeing here in Canada. So these private equity funds are under a lot of stress right now.
Yeah, it's a bit of a bubble, isn't it? It has been for quite some time. But I mean, it went up for so many years that I think people got complacent at that. It's going to keep going up. But relative to what other countries have in terms of real estate values, Canada is high, is really up there.
You're right.
And so I guess people just figured, I'll just go on forever. And who knows? Because as the economy gets softer by the day, we're not creating jobs. We lost 84,000 jobs last month. And so now we've got inflation easing. It's down to 1.8%. I guess that's the latest number. But I think it's easing because our economy is tanking. I know that's the real reason why our economy is not doing well. People are hunkering down. They're not spending as much money. And when that starts to happen, then demand slows and prices slow down as well. And that's what we're really looking at. I didn't see that in the Globe and Mail today. They had different types of analysis. But what makes sense is you've got a slowing economy, and that's probably why inflation is easing. What do you think?
Absolutely. We see that in a couple of interesting areas. Not that people are preoccupied with RVs, but it's interesting to see that the recreational vehicles have dropped by 50% in value over the last year or so, just looking at some of the articles. Now, some of that area got pretty excited in the market during COVID and so forth. Everybody wanted to buy an RV. But the point is, some of these recreational vehicles or Sea-Doos, jet skis, things like that, you're seeing sales just plummet. And I think, again, that's because these are completely discretionary items. You can easily put them off. Anything that you can put off that you don't need, these areas are going to be under a lot of pressure, consumer discretionary items. And I think you're going to continue to see weakness in the market. As investors, we stay clear of all of the businesses that are offering a lot of consumer discretionary. We'd rather have consumer staples, the stuff that you need to buy to survive every day. Those are much more consistent businesses. So in Canada, yeah, you're going to see weakness where people don't have to spend the money. I think you're seeing that in the auto sector also. I'm talking to the friends that are in the auto sector working on the retail side, and sales are off. And it's also much easier if you are ordering a new vehicle. You can get it a lot faster now. It's coming through and there's not the delays anymore. Again, we're seeing economic weakness right across the board.
Which is different from what you're seeing in the United States. Yeah, you've got the media desperately trying to knock Trump down ahead of the midterms. And I think I saw a story on the weekend that suggested that Trump got lucky on the economy. To me, it's sour grapes on the part of his critics in the media. But things are growing. The measures that he brought in to boost the economy are working. And you're seeing job creation. You're seeing the housing market steady, growing. It's not explosive growth, but it's the kind of growth that is sustainable in the long term. And so things are going pretty well down here.
And you have to remember also in the States that they're shrinking the public sector. They're actually having job losses in the public sector and absorbing that quite well. And they've also shut their border. So they've also had a lot of people leave the country that were illegal and shouldn't have been in the country in the first place. And so you've had that, which again, it's a lot of noise that's circulating in the marketplace at the same time. But more importantly, as you point out, when you look at the policies that the Trump administration is pushing, again, lower taxes, no taxes on tips, no taxes on Social Security, lower withholding taxes so that people started in January are getting more money in their paycheck. As these things start to filter through the economy, along with, I might add, which is really important, 100% write-off of capital expenditures. So if you're in a business and you're investing for the future and you're buying capital, you can expense 100% the first year. That's a massive incentive for investments. And so that, again, it takes time. Remember, they inherited a dreadful economy and just incredibly weak circumstances from the Biden administration. So I think, again, given everything that's going on in the world, given the overall weakness and a war in Iran and so forth, it's the American economy is continuing to be quite robust given all of those headwinds. Trump has created a lot more opportunity for growth.
Pierre Poilievre, leader of the Conservative Party of Canada, has his own auto plan, which he has speaking about, and he traveled, for instance, to Windsor and Detroit to talk about it. And let's listen to his clip here. This is him talking about the idea that for every car produced in Canada, the same manufacturer would get to sell a car in Canada duty-free.
We want to bring home production through performance by implementing a rule for every car produced in Canada, the same manufacturer would get to sell a car in Canada duty-free from a CUSMA partner on a dollar-for-dollar basis, similar to the 1965 Canada-US Auto Pact. Simply put, every time an automaker makes a car in Canada, they would have the right to sell a duty-free car in Canada. This would create a powerful incentive for them to relocate and repatriate production back to this country. Because right now, we buy almost twice as many cars as we make. But automakers who want to sell in our market would have to make in our market in order to do it. The same would apply for the other countries in the USMCA.
Now, that makes sense to me. Do you think that would work?
It does make a lot of sense. In fact, I'm a little surprised. I haven't looked at the numbers. I'm assuming he knows them quite well. I'm actually surprised that it's a 2-to-1 ratio. I would have thought it would have been a lot closer and maybe more favorable to the U.S. in terms of the production. But if that's the case, no, I think that gives us a lot more leverage and opportunity to be able to negotiate with the U.S. The key thing is, Mark, is look, we've got to be negotiating. We've got to be at the table. We've got to be putting things on. We've got to be able to give up something to gain something. But it's critical. It's absolutely essential that we're negotiating in the United States. And the auto industry is amazingly important, especially to Ontario and the spin-off benefits. And you've got an industry like auto assembly, but all the auto parts, you've got all of the other industries that are impacted by that, the service sector and so forth. If we lose more of the auto industry and the manufacturing and assembly of autos in this province, it's going to be devastating for us. It is a very important, high profit generating, capital intense sort of industry that produces a lot of jobs and a lot of wealth. And so we've got to be coming up with different plans and surfacing. It's good to see Pierre Poilievre with some ideas and out there talking to the Americans. We've got to be doing that. Carney is doing none of this. All he's doing is irritating the U.S. and creating more tension and thinking somehow that's going to work out well for us. And it's not. It's going to be devastating. The Japanese companies have already said that if CUSMA is not renewed, they are leaving the country. They've made that clear. They've told people. So we know that now. We've got to be negotiating and working hard to keep them here. We've got Toyota, Honda, a whole host of these important companies making and assembling autos in our province.
Speaking of the Japanese, they have now signed a deal worth $56 billion with the United States to import energy from the United States. And this is a post by Table Salt. It says Japan, a massive importer of energy, signing this deal, making the USA their main source of energy purchases, dealing a massive blow to Canada and its plan to expand the TMX pipeline system. You snooze, you lose. The Japanese came to Canada during the Trudeau time in office and said, look, we'd love to get more of your LNG. And they were told that there is no business case for that. Apparently, Trump disagrees with that. And so he's growing the U.S. economy while successive liberal governments now have been destroying our economy. This is what happens when you don't have a grasp of the economy when it comes to energy. Unless, of course, they've got some kind of ulterior motive that involves wrecking your own country. It just boggles the mind what's happening now with this. What do you think?
Well, you're exactly right. Either it's controlled demolition of our economy, people absolute fools. To say there's no business case when our gas is trading at a couple bucks a cubic, basically at a couple of dollars, and you can sell it at 4 to 6 times more internationally, and there's no business case, it's just ludicrous. And you can only look at it as either gross incompetence or they want to basically have a controlled demolition of the Canadian economy. And unfortunately, I think it's probably more the latter. You just cannot be as stupid as we've seen our leaders in terms of their energy policy from the federal level.
Yeah, incompetence doesn't explain everything. And this is a perfect example. You just have to shake your head and wonder what people are wondering when they vote. Anyway, how do people get in touch with you and find out more about the great services offered at Rocklinc?
Sure, we'd love to hear from some of the listeners. Rocklinc.com is our website. And if you email us at info@rocklinc.com, Rocklinc with a C at the end of link rather than K, then we will respond right away. Love to hear from you, review your portfolio, and give you some ideas on how you can protect yourself and grow your wealth over time.
Jonathan, thank you so much for coming on the show. Great to chat with you once again.
Thanks so much, Mark.